So this is June 23rd, 2022, and we're looking at the E-mini S&P September contract for 2022, and this is an hourly chart, so I'm cutting right to the chase here. We had sell side liquidity here, the market dropped down, took that sell side out, rallied up, buy side here. I was looking for 38.05 level today, and this is the reason why. And I was looking at it early on in the morning. I wanted to see it run up here and hit that. If it was going to hit it, I would have been watching for a potential short to form, but it didn't do it. So that was my expectation based on this high back here. We already took sell side, so I was looking for a little bit deeper run into this high here. When we just went just above that short-term high there, gave up the ghost and went lower. And I had a trade that got stopped out plus 2 points. And I'll talk about that when we get into the lower time frame. All right, so here is the 15-minute time frame. And usually I have the chart that's blank, and I'll ask you to take a look at it. Looking at this morning, we had the 10 o'clock PAL event here, and the market started to run up, and we took out the buy side here. But again, I was aiming for this. This is what I wanted to see. I want to see it run up here. And I actually took a long in here. I was wanting to see it run up into that level, and I was going to do a reversal, and it didn't obviously give it to me. So notice the time of day here. This is the New York Index AM session. Operating hours, or kill zone if you want to call it that, and it's 8:30 in the morning to 11. Now I can take trades after 11 o'clock, but I want to kind of like stick to the rules and present you opportunities to see where following the rules you're going to miss certain opportunities. It's okay, it's fine. You're going to get it wrong sometimes. You watched me get something wrong today. There was no skin off my back. Nothing bad happened. Is I didn't get what I was looking for. And because it was late in the day, as we'll look at the lower time frame in a moment, but it ran above the short-term buy side liquidity here. I wanted it to run up to here, but it broke down. And I was telling myself, and also made my views public on Twitter, that I wasn't interested, and I wasn't quite sure what it wanted to do because it was approaching that noon hour. And I took a trade, and I was out +2. So in other words, I was just covering expenses, basically. And I was wrong on the initial run. So when I have that scenario, and it's off of a Fed chair or a high-impact news event, and it didn't pan out like I was expecting it to, in my experience, it's been better for me to just move away and say, okay, I'm going to close the computer, and I'll come back later on and see what's going on. And I didn't want to trade any more of the morning session leading into noon. So I had waited, and I was going to take a look at what it did in lunch hour and post lunch hour around 1:30 and see what there was opportunity to do anything then. But we have a fair value gap on the 15-minute time frame here. See that? So the market eventually, after running the buy side here, drew all the way down, took out sell side here, overrun this fair value gap here. Why did it do that? Because this is a larger one. So if it's going to go over top of this one and trade to the top of this candle, which is the low end of that fair value gap that's here, it's not noted. I'm showing you by the respective candles. If it's going to go here, that's also the high end of the fair value gap here. So it's likely to go over top of this one and run into this one. Okay. And it does that as we're going into the noon lunch hour in New York until 1 o'clock, where it makes the low of the session after closing in the fair value gap. And then the 1:30 to 4 New York local time, that's the PM session, New York Index PM session, or afternoon session for index trading. And the market started to create a willingness to want to go higher. We'll look at a short-term shift in market structure when we get in the lower time frame. But it draws all the way back up to the target I was looking for in the morning. So the expectation of going to that specific level, let me explain to you what I was looking for. I wanted it to go above, hit that, and then sell off and go down to this area here for a discount, and then create the run, and then go beyond 38.05. That's what I was really looking for today. That's what I wanted to do, but it failed to get to 38.05. It fell down into this area here, and I knew once it broke here, I don't want to go short because I'm going into lunch hour, and I was concerned it was going to consolidate a lot and then take forever to get down into, and I don't want to hold anything new into lunch. So I prefer to see some kind of a stop run in the lunch hour, which is what we're seeing here. It runs down below that and into a fair value gap, deep discount between the low high, trades down into it, and then rallies up. This session here, we'll look at it on the 5-minute chart. So we can see, obviously, the initial poke above here. Inside this area, I was looking at a 2-minute fair value gap. I mentioned that on Twitter as it was forming, and it rallied up. And then once it took the short-term high out, when this was a bold-faced bullish candle, I was thinking to myself, okay, it could expand up in here, and I'm watching that. And I had a tweet ready to go. I'm going to sell short here and look for a rundown into this level here. Never got it. Okay. And then some of you probably going to hear this and say, oh yeah, sure you did. I mean, it is what it is, folks. I mean, I was out there without a safety net. I told everyone what I was expecting, what I was looking for. It just simply didn't pan out, and that's okay. But the market eventually breaks lower. Then after we get into the lunch hour, closing at 1 o'clock, and then I personally like to wait till 1:30 because it's a little bit more cleaner price action. The market starts to rally away, drops back down into an order block, a fair value gap on a 5-minute chart. Then we have a shift in market structure here on the 5-minute chart. Creates a small little return to a fair value gap there, rallies, another fair value gap, it runs into it here, rallies, and eventually takes out the short-term high of the day, and then runs to the level I was drawing your attention to on Twitter. All right, so here's the 5-minute chart zoomed in with the morning session. You see the run here on the buy side, one more here, and eventually breaking down. Displacement, small little fair value gap here, rolls down into the fair value gap here, and then once again, returning back up into an imbalance, then runs down to the low end of the fair value gap. Turning basically at the low of the session at the low end of the fair value gap at 1 o'clock. So closure of lunch time hour, it creates that low. This right here is the 2-minute chart, and this is the fair value gap I drew your attention to live. And it came down into it here. And inside this fair value gap, I was basically drawing attention to that as a potential long idea. And I was looking for a run into 38.05. And it started the run, took out the buy side here. I mentioned the buy side would likely be a draw on liquidity. It was, but I wanted to see it draw up to here. That's the specific level I was looking for. And the market comes back down into the fair value gap again once more. And then rallies above the short-term high here. This right here would have been a nice opportunity for me to basically say, pay the trader, and me take something after I tweeted that off. But I didn't, because I wanted this level here. Okay. Now one could argue and say, oh, you're being greedy, or you didn't follow rules, or you didn't do this and you didn't do that. And it's easy to armchair quarterback someone. And it's okay if you want to do that in the comment section, that's fine. But just know that I'm doing this real time. And I'm okay with being wrong. Wrong isn't going to ruin me. I'm not 100%, but I'm generally on par, better than the average bear. Okay, we'll just say it that way without sounding like I'm bragging. But once it came back down in, it stopped me out because I rolled my stop up to a level that I wasn't willing to weather a deeper retracement, because this is the takeaway. Fair value gap, we trade down into it, we get movement. That's good. Comes back down in again, complete closure of the fair value gap. Okay, that's acceptable. Does it start to rally away? Yes. That's why I felt confident that it was going to go up to here. Because if it was going to go above here, then it should just spread its wings and run that 38.05 level with no problem. It wasn't having it. The market dropped back down and didn't quite take out this short-term low with any displacement. So while this fair value gap exists, it's not one that I would have taken, because we didn't see a displacement with meaningful movement below that low. So this is not a fair value gap that I would have been a participant in. So looking at that, I'm thinking I'm not interested. I'm going to close up shop, and there it is, because I didn't get this run below here. Now, had I seen that, I may have, I'm not going to go out on a limb and say absolutely, but I may have, if it would have shown like this type of movement on this candle below that low, and then we moved back up into this right here, then I probably would have said, well, I'm going to go short and aim for this low here. And then at noon, if I didn't get here, I would just close it off and then ride out the lunch hour. We had another fair value gap in here, trades up into that nice closure perfectly, and runs down to the top of the fair value gap on that 15-minute time frame. One more little bounce in, then rolls over and goes deeper into the fair value gap. All right, here is the afternoon session, and this is where we're going to be doing the bulk of the discussion in the remaining portion of this video. And I'll frame the logic around risk management and stop loss management. and that'll complete the model. The rules I'm going to give you are static. They're always the same, so that way you know once you put a position on your demo account, where is your stop, how much are you risking, when do you move your stop. Okay, and it's a 2-minute chart showing the afternoon or PM session for index futures. And you can see we traded down into, this is showing a weird time because it's 2 minutes, but this is the 1 o'clock hour. It hits the low and then starts to rally up. Short-term shift in market structure here. Key time of day, 1:30. It trades back down into an order block, last down close candle. There is a fair value gap right here. I didn't note it because it's going to be too cluttered up, and I'm going to be basically doing a lot of discussion in this area, and I don't want it to be overlapped with too many things to be navigating. So this is the 15-minute fair value gap, and it's trading down to an order block after a shift in market structure, after trading down and closing in a 15-minute time frame. Fair value gap, and then it trades into an optimal trade entry, which is the flagship pattern of this YouTube channel. Fair value gap with an order block and optimal trade entry is the gold standard of the ICT pattern that's taught on this YouTube channel. This is where you can be long and expect price to reach for here and here. Okay, so we have objectives in here where we can look for this imbalance here, buy side liquidity here, buy side liquidity here, and we'll watch and see, does it continuously march higher. So we have a run from here to the short-term high. Then we have this fair value gap here that runs here up into the 30.05 level. So this PM session I was long in, and I'm not going to try to build the case to outline everything because I want to give you what's salient to close this mentorship and show you how to use the stop placement, risk management, and give you a working example. All right, so we're zoomed in here and looking at the 5-minute chart. And again, that's the fair value gap we're going to be using here to frame it. So if you're looking at the idea of you traded down into that fair value gap, does it show willingness to go higher? Yes. Is there a short-term shift in market structure? Yes. Is there a gap? Yes. Down close candle to the left of it? Yes. Drops down in, bullish order block, optimal trade entry. In other words, that would be a 62 to 79% retracement level, less than equilibrium relative to the high and the low, respectively. So we would be looking for a limit order to be at 37.5475. We'll use that. Okay, so 1/4 point less than this candle's low. So that would be our hypothetical limit order to buy going long. And we have to use the low here for our stop loss. So 37.45.75. Essentially 9 points of risk. Okay, so we'll come back to that in a couple minutes. But for now, what we'll be reaching for, what will be the draw on liquidity from this high down to that low, we want to get to a premium level. 50% is about right in here, eyeballing it. We don't need to have a fib on that. You should do it for yourself. But then we have this imbalance here. So the first low-hanging fruit objective would be this candle's high. That's 37.80 1/4. So we're looking at about 25.5 handles of potential points profit per contract. So we're risking 9 points to make 25.5. Not bad. It's better than 2.5 are. So you're going to risk $1 to make $2.50 basically. And that's on a run from here to here. We don't need to know if it's going to go up to here yet. Okay. This right here is one trade from here to here. Then it creates another opportunity in here where it can run from here to here. And we'll talk about that when it gets into the discussion on risk management and trade management. When you place your stop loss down here, when can you and when do I move my stop loss? Well, you have to determine where you're getting in at and where you're trying to get as a target. So that's your range from 37.54 3/4 to 37.80 1/4. So technically 25.5 points. Okay, so what is that? 12 3/4 points, something like that. Let's round it to 12.5 points. If we see price move 12.5 points above the entry point that you entered at, if it moves 12.5 points, your stop loss can move 25% up. From where? What's 25% of what range? Where your stop loss is and your entry. So split that range in terms of points. If this goes up 12.5 points, which would be 50% of your expected range, then your stop loss can be reduced or trimmed down to 25%. So it's going to give you that little bit of a cookie, that feel-good moment. You trimmed some of the risk. You're not jamming it up above the break even. because you're going to worry about it. You're just moving a little bit. Now, when price moves to 75% of the expected targeted range, and it means from your entry to here, if it moves 75% of that, then the stop goes to break even. Period. There's your systematic movement of your stop loss. You're not jamming it to break even. You're not going to be worried about getting stopped out. You're going to be more likely to be watching, does it still keep reaching for your objective? Do down close candles keep supporting price? Does it run below short-term low and run higher with a lot of energy because it took short-term sell stops out? Is it dropping down to a fair value gap and reaccumulating and sending another higher price leg higher? That's what you're watching. That's the things that you're looking for. And as long as it's doing those things collectively or individually, you are on side. That means you're on the right side of the market, and keep holding for your position to hit target. If you are doing multiple positions, say you're doing competition level leverage, and for me, that's anywhere between the range of 3% to 4.5%, then you're going to be looking to take partials. Okay. And that partial might be, once it goes 20 points in your favor, you have a static number. It always hits 15 or 20. Once it does that, no matter what you're doing, you take something off. Okay. That's something you might want to incorporate in your own trading model as well. But that part is for you to determine. Don't let me give you static rules that are considered, cast in stone, ironclad, can't change it. I hate doing that with my students because it takes away the uniqueness, the individualism that you're bringing as the trader to your own model. So these are just basic foundational points that I think will serve you well, but you're going to obviously evolve and come up with better ways that meet your expectations and also fit your personality. Okay. So I think that's going to be it. And I absolutely want to congratulate all of you that have gone through every single one of these videos. If you've done the work and back testing and looking at things and studying, and you're convinced that the pattern's really there, kudos to you. Okay. For those that have not got it yet, my encouragement is for you to keep doing it. And I promise it won't take you long. In fact, if you just started and you just found this channel, I promise you, if you give it 6 months, you'll see things that you never saw before. But at the end of 1 full year, because it might take some of you to do that, you'll have it. You'll understand what you're looking for. Doesn't mean you're going to be trading every single day. It doesn't mean you're going to know the bias every single day. It doesn't mean you're not going to have losing trades. It means that you're going to know what you're doing. And even though you may have short-term hardships with being stopped out or missing moves or reading it wrong, you still will have enough faith in this model because you know it will repeat in the future more times than it fails. And I'm challenging you to determine whether that statement is true or not. Until next time, good luck with your trading.